It's not that you're sitting back on a lawn chair and doing nothing. It's really the act of not overreacting. Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management, and I'm here each and every week to help you better understand your finances because, after all, your money matters. We got a good one today. I'm going to talk about tightrope walking, otherwise known as, get this, embolism. You already learned something today. Now, you're probably like, Brad, what on God's green earth does financial planning or investment management or portfolio structure have anything to do with tightrope walking? Well, you're going to get ready to find out. But before you do, smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. So let me start today by telling you a little story. There was a man named Nick Wallenda who was a 7th generation member of the famed Flying Wallendas, a family of circus performers, before he ever took his first step above Niagara Falls or the Grand Canyon or Times Square or any other crazy feat that he's trying to accomplish. A lot of work has been done to ensure a safe journey to the other side. So let me give you an example. On a walk, let's say above Times Square, where he's walked 25 stories above the city streets, Wallenda and actually his uncle Mike, an engineer, took everything like wall thickness and building measurements into consideration. They created drawings of distance and height, all to understand where best to secure their wire. They use something actually called a dynamometer, which is basically a big scale to determine the ideal tension, which, again, ensures the right amount of sag in the middle of this wire. Now, he chose the right wire, usually deciding something like a galvanized 7x19 inner core wire, which is essentially rust-proof for any of us who knows wires out there. It's rust-proof, it's highly compressed, and uses very little lubrication on the wire. And then, after all of that, there's putting up the wires, which can include screw pin anchors, stabilizer cables, and a 500-ton hydraulic crane. Now, there's a reason why I'm giving you this backstory here. With all of this structuring in place, they then begin preparing for possible obstacles. Like during training, we'll end up practice in front of an airboat revved up to like 70 or 80 miles per hour. He's actually even researched the sun's position on walk day. He prefers it to shine from directly above versus the side or somewhere else. And things like rain. Now, while rain won't necessarily cancel a walk, he and his team carried a portable weather system to make sure there were no lightning strikes within 15 miles of the area. Friends, I'm sharing this to simply illustrate something that many of us probably don't even consider worth watching. We kind of think it's crazy, right? There's been movies about this kind of stuff. We know there are somewhat daredevils around this, that, and the other arenas or just people that do different things. But the amount of preparation, to me, is what makes me interested. Not the actual feat itself, because to me, that's just ludicrous. But I digress. But what really gets me going is the preparation behind it. And it surprises me and really impresses me. That's why I wanted to share the backstory here of tight walking and the Flying Wallendas. And if you look up the Wallendas, and many of you might have heard of that name before, they are the most famous tightrope walking family out there, the Flying Wallendas. Now, investing, to be fair, is not exactly analogous to fun embolism, which, by the way, again, is what tightrope walking is officially called. It's not life or death, after all. But here's where my dovetail is between these two topics. To be successful at both tightrope walking and investment planning or financial planning, planning ahead is crucial. Once the client's goals, once your goals are understood, we then, as portfolio managers and advisors, instill safety measures, forecast and prepare for possible variables, likely and unlikely, and again, not too dissimilar to what the Wallendas are doing when it comes to tightrope walking. It's an important reminder, and why I'm bringing this story up, to kind of tie it together and work discussing again, especially at a time when markets and really bonds have been down for almost a full year. The first time, 2018 withstanding, that this has happened since 2009. And the possibility, by the way, of also higher rates and to some, a definitive recession that lingers in your portfolio, in the economy. And in your portfolio, for clients listening or watching right now, it's designed and consistently tweaked to withstand this and continue to grow well into the future. And for those that aren't clients of ours here at One Capital Management, make sure you're looking at your portfolio and talking with your advisors about those same things. You want to make sure it's weathered. It can handle these things. And your portfolio manager and your investments are seeing the possible, and sometimes to many might think the impossible outcomes that might be out there. And let me share this. And the notion of the show here, Make Your Money Matter, on our radio programs, at our dinner events, on our podcast, and on our YouTube show, the tone of it's always through the lens of fundamentals. We don't get paid to be bullish or bearish on anything. This is about pragmatic and factual discussions. But let me share something that I think is important for all of us to hear. And I don't know who I'm speaking to right now, but just let this sink in. We've made it through wind and rain before. We've made it through all the obstacles that a tightrope walker would have prepared for. There's an old saying my grandfather used to tell me, right? If you're dealing with something right now and you're thinking about how that situation might have arose in the past, you've made it through everything you thought you wouldn't. And that statement, I always remember thinking that. I'm like, oh, he's right. So this is not that it's not a concern or whatever I'm going through right now, but I've had these concerns before in the past, and I'm here dealing with it. Means I made it through that. So we've made it through everything we thought we wouldn't before. And I think that notion going into 2023, I think that needs to speak to our hearts sometimes. And for us here at One Capital, we've done those things in your portfolio, in our clients' portfolios, to plan and prepare. To paraphrase the famed economist Paul Samuelson, now is the time to sit and watch the grass grow. Many of you who have followed me for a while have heard me call it actively waiting. And when an economist like Paul Samuelson brings up his statement of it's a time to sit and watch the grass grow, it's not that you're sitting back on a lawn chair and doing nothing. It's really the act of not overreacting. I want to say that again for someone who's watching or listening. It's really the act of not overreacting. And many may think you're not doing anything or your portfolio manager's not doing anything, but the reality is we're actively waiting. Good portfolio managers are actively waiting. We're being active on the things that we see that are for sale, but we're also waiting on the positions that we've already purchased or have in our clients' portfolios that have taken a cut over the past year. And fundamentally speaking, we see value in them in the years to come. Now, of course, individual circumstances and fortuitous and otherwise situations may call for a tweak now and then. And you might have found yourself, maybe, let's say you're in the camp of, you found yourself with extra cash, wondering maybe right now if investing during a down market is wise, or maybe the more stressful situation for some out there, if you're in need of cash and worried about the potentially deleterious effects of taking it out of your portfolio, or maybe just being worried in general about, let's say, higher interest rates. In the first case, real quickly, I mentioned, the simple answer can be found by actually tracking the market's valuation as measured by its price to earnings ratios and earnings yield, something we actually, again, back to what I mentioned earlier, we call fundamental investing. And what you'll find is prices came down last year, as we saw, and earnings, yet if you look at it, earnings are still expected to grow through 2023 and beyond, albeit forecasts are for a slower growth rates. Now, in other words, companies are on sale, and relatively soon, maybe a year or two or three, history and reason tells fundamental investors like us that prices will also follow. Not necessarily across the board. You want to find the right ones. No one has an exact prediction of this. And if you feel like someone does, by the way, or they are making that claim, please run, because it's probably not true, okay? But in a couple of years, maybe sooner, history and reason tells us fundamental investors, that prices will follow, meaning appreciation will follow. Now, of course, these things I'm mentioning, if we look at just our life in general, they never happen in a tidy manner. I mean, buying today at reasonable prices doesn't assure you're going to see an immediate increase in value tomorrow. Likely, there will be some volatility. At One Capital, we include this in our calculus. As I mentioned before, we install the safety measures. We look at the forecast and we prepare for possible variables, likely and unlikely. So this is definitely included in our calculations. And I would just advise anyone out there, and the reason for our show is to make sure that we instill some education that you might have in your portfolio if you're doing it yourself, or maybe instills a conversation you should have with your portfolio manager. And with that, I want to shift with some specifics for a second and give you some context before we get out of January. I think context is going to be a really big theme this year as we set the tone for our minds around some behavioral items to look at. And I want to start with bonds for a second. Look, I'll be very clear about something. I've been doing this for almost 2 decades now. Bonds are probably the least sexiest thing in the investment world, but I'll share you a little anecdote. They're the things that run the market. I mean, the 10-year note, our treasuries, our mortgage rates, they're all run on bonds. So they're important. And their yields are, and they're measured by the US Treasury bills, they're 4% higher than they were a year ago. Let that sink in for a second. They're 4% higher. Let me give you an example for a second. A 90-day T-bill paid 0.06% on the last day of 2021, a little over a year ago, and 4.42% a year later. Now, accordingly, a 1-year bond paid 0.39% and now pays 4.73%. Now, by the way, go up to the 10 years and you go from 1.52% a year ago to 3.88%. That's an increase, friends, in yield of 74 times for the 90-day T-bill, 12 times for the 1-year bond, and 2.5 times for the 10-year. Let me just state something. It's a good time to be in the bond business. For many of our allocations, and for those thinking like we should be in more equity, for the past 15 years of my career in particular, we've had bonds as a diversification, as a placeholder, and they've paid relatively handsomely, but nowhere near what we're going to see now and really into the future. So for those of you out there who've been investing for the past 15 years or so, we've been in a low yield environment. We are now finally going to get paid for things like fixed income, paid very handsomely at a very healthy rate. So bonds are a great piece to the portfolio, along with equity and dividend values for certain equity companies. Now, if I've lost you all of a sudden because I mentioned bonds and you're like, oh my gosh, this guy's going to bore me to death, remember, they might be boring, but they're a big part of your dividend strategy, your yield strategy, and ultimately your reallocation and rebalancing strategy as you go into volatile years, especially while you have high rates. Because we might be, moaning that we have higher rates on debt, but at the same time, you look at your CDs right now, your money market accounts right now, something we spoke about last week, as well as your fixed income, we're getting paid handsomely for cash. Think about this analogy for a second. If you're going to go to the store, best to go when everything has a red tag, right? We just saw that in December, last month. And right now, nearly every asset that we see on the planet, at least in our view, is on sale. Doesn't mean that's not going to come back and it hasn't devalued, but literally everything's on sale across the board. I mean, last year, as we all can imagine, it tested everyone's mettle, right? But it's the reason assets are now so attractive, dare I say, downright cheap relative, again, to expected yield or cash flow over the next several years. Discipline and discernment, my 2 Ds I always speak about, are really what's going to be the focus of this year, I think, as we share on the Make Your Money Matter show, around making sure that you actively wait, find the positions, find the allocation that works for you, and make sure you sit and watch the grass grow, if you will. Now, if you're looking to hold investments, just for anyone out there, for at least a year or so and have the cash, this is a wise time to invest. I wanted to go back to my question I stated earlier, a fictitious question, but if you're one of those people right now who has cash and you're thinking, is now the right time wise? I mean, again, everyone has their own unique circumstances, but yeah, if this cash isn't needed in the next year or two for certain things, now's a great time. But sometimes, again, we find ourselves unable to sit and watch the grass grow or plant more seeds or whatever analogy you want to use. So if you're in a position where you need cash, this is, again, probably where you want to talk to your advisor. If you're looking for an advisor, if you have one, now's the time to speak to them about the context of your cash and your overall cash position. The first question I think you'll be asked by me as an advisor, I'll speak for myself here, is this: is the cash you have, is it for a need or a want? Those 2 4-letter words I focus on when it comes to retirement or just being financially free, need and want. If it's the latter, perhaps it can wait until asset prices recover. If it's the former, I think any good advisor in my opinion, will help you find the best way to access cash, whether it's borrowing or selling an asset that's maybe not quite, down quite as much, or just finding some areas to be efficient with your money, which, by the way, brings me to the idea to our process. And to use my example from the Wallendas, our process here, just as an example, at One Capital Management, we're constantly working to get all of our clients safely across the wire. The key is balancing, okay? It's all a tightrope balance walk, right? Tightrope blocking is all about balancing, right? The preparation is there, everything's set up. Now you just have to balance yourself to get across. And in his case, the Wallendas, wearing suede leather shoes, which by the way are made by his mom. Found this out in my research. Made by his mom, and a 23-foot long, 45-pound pole. That's all he uses. But here's my bridge I want to make. One Capital, at least our perspective, is perpetually rebalancing our client's portfolio, consistently watching the movement of assets, many of which, by the way, behave differently in the short run. So be aware of that. Most often, stocks and bonds are a great example of things that move in different directions during the same time frame. That's called uncorrelated assets. They don't need to move in the exact opposite direction in order to tamp down your portfolio's volatility. It's just temporary pricing of the assets that has moved. And sometimes, as I shared last week and the week before that in particular, sometimes emotions get the better of people, or the markets and assets get cheaper. So with fundamentals, the way we look at it, we study it and we set the prices, we'll recover and they'll reflect the true value of an asset, whether it's stocks, bonds, real estates, tulips, crypto, baseball cards, whatever it is. I mean, you name it, whatever asset class you want to bring up, if the fundamentals are studied in their set period, the prices will recover and reflect always the true value of an asset. So just bringing you into where we are today, for us, we trim assets that have outperformed their peers in our portfolios. For example, if stocks appreciated 20% and bonds appreciated 4%, and by design, our asset allocation for a client is 50-50 or 50% of your portfolio, you think about it, 50% of the former now represents 54%, right? So while managing taxes or items like that for after-tax accounts, we'll trim stocks and fund bonds to bring your portfolio back to the strategic allocation, which in my example is 50-50, which by the way, is essentially the definition of rebalancing. And again, if you're not a client, that's not the point of my statement there, is to make sure you're having that conversation with your advisor. Remember, in the initial planning of any client's portfolio, at least I'm speaking from an advisor's perspective, and if you're working with an advisor, it's important to discuss all the things that could happen throughout a year with them. We do this with our clients in sharing the distribution needs and the forecast we have, because the impacts of markets like 2022 factor into that. In fact, we run simulations, and for any of our clients out there who have gone through our planning process, we call it our black book. We've ran situations which includes good and bad markets to find the optimal allocation for your assets and realize for yourself the probability of the successful outcome of your retirement. Let me stop there for a second. Did you know you can do that? You can. It's called a Monte Carlo scenario. Make sure it's run for you. And believe it or not, for those clients that may haven't heard of this before, and for those that aren't clients, it's possible to understand your probability. Yes, it's forecast, but really you're taking 1,000 different scenarios. Again, something called a Monte Carlo. We do this for all of our clients. You take 1,000 different scenarios, everything from the really, really bad to the really, really good, and all across the board. And you can see where your portfolio and your allocation lines up and stacks up relative to your distribution rate come retirement plan time, or come time when you want to be financially free and not work for your money, but your money work for you. And to me, that answers the biggest question that any of my clients have, whether they have an asset or I know they're thinking about it, and I know subconsciously they know it's there. The question is this: will I be okay in retirement? Will I be okay to leave my job? Do I have enough to live the life that me, my wife, my family, my spouse want to live in retirement to support them? The planning process that I'm sharing today through a story of tightrope walking, believe it or not, is tried and true. It has its calculations. It has its forecasts. Yes, it works. Now, entering 2022 last year, we were intentional on being shorter in our duration on bond allocations, as an example for us, in order to protect principal more effectively. When interest rates rose, as of course we saw that they did. Now, we didn't know it was going to raise as fast as it did, but again, we were ahead of it. Make sure your advisor's ahead of it. We knew it had to be increased if you just look at it logically. So we went short on our duration so that our clients didn't get hurt by what we call interest rate risk. Essentially, when interest rates go up, bond prices go down. We wanted to be careful of that. We were also lighter in our allocation to higher valuation companies like those in tech and telecom, and heavier in more favorable valued companies like energy. One of the reasons why we were able to protect our clients' downside. As history has taught us time and time again, higher priced assets such as 2022's technology and telecom that led, by the way, the market's march down last year, following 28% and 39% respectively. we were actually moving off of those positions and moving into more reasonably priced energy companies, as an example, which were up a whopping 65% last year by shorter duration government, and quality credit was also down 5.5%. All that to be said, while the broad and longer duration market, as noted, was down about 13. All this to say, again, raising cash for our clients' needs, emphasis intended here, they can be achieved in ways that protect actually your long-term goals. For any client out there, again, who's gone through this, if you're working with us or a quality advisor, you understand all this. All of our clients have gone through understanding not just their rate of return that they need to achieve, but also how much they'll be needing when they start using their assets, whether it's retirement or just in general becoming financially free, because that, my friends, is equally as important when it comes to building the right portfolio for yourself. Our process here, I know, is tried and true. We buy low and sell high, perhaps not always to perfection because we don't have a crystal ball, but it helps our clients meet their goals. One methodical, balanced step at a time, not too dissimilar again to the Wallenda family and tightrope walking. Okay, it's time to answer your questions. If you have a question or topic you'd like me to address, you can leave a comment or a question in the comment section. Or again, if it's something more one-on-one, you want to go through more personal with myself or one of our advisors, just go to the About page on this channel, send us an email. We'll always keep the questions I read here anonymous, so you never have to worry about your name being shared, but we would love to hear from you. And a question that came in this week actually was timely regarding this year's investing and volatility. The question came in, I found myself with more cash than I expected based on what I need for emergency funds. Would you suggest investing? So I want to start off with this question, which is a good one, by the way, of what I said earlier. Obviously, every situation is different. So what I'll share is this. If you have your 3 or 6 months of what I'll call emergency funds in place for your cash and you still see you have more available, I would say yes, it's a great time to invest. Again, everyone's situation is different, so you want to talk with your advisor or you can give me a call directly to go through more specifically your overall planning. But generically speaking, yes. I think more than anything, if you're going to keep it in cash and you might see something with it in the next couple of years, at least go and find a really good money market or CD right now because they are paying way more than they were a year ago. So that's number one. I've come across a lot of clients, even on our radio program when they call in, they're even not really sure that a lot of rates right now in money markets are in 3 and 4%. We haven't seen that in a long time. So at least start there. Past that, when it gets in the investing world, that's where you want to really sit with an advisor and see, okay, do I want to go into equities and fixed income and build a portfolio around my cash? That's a different subject matter. But in general, I would say being efficient with your cash right now is important, especially while we still have inflation. Because if you're sitting over there at a 0.5%, maybe 1% checking account and inflation's still running at 5 or 6, your money's not keeping up with the price of goods. So we want to at least bring some of that back into your world. Then past that, the investing is really where you're going to talk to an advisor. Great question, and thank you for bringing that in. Again, if you have a question or comment you'd like me to read here, you can leave it in the comment section or email us in the About page on our channel. Well, before we go, if you found anything helpful today and want to learn more, you can visit our website at onecapital.com. You can also scan the QR code on the screen with your smartphone. It'll get you right there. You can also call or text us. We want to help. Listen, there's no pressure here. We don't treat people like a number. I say this every week. We value our relationships. It's the lifeblood of what we do. So click call or text us today. If you're not following us on social media, you should be. You can follow us at Make Your Money Matter. We're sharing great information on all of our social media platforms. And as I often say as I end the show, if you enjoy the show, share with someone you like. And I guess if you don't like it, share with someone you don't like. But until next time, always remember, make your money matter.